Lynn, I just ran the numbers. We can either have a $700,000 account or a $2,000 monthly check for the rest of our lives.
Wait, Frank, stop. 700 grand? That's the winner. Why is this even a conversation?
Because that 700K portfolio, it only pays us like $98 a month.
Wait, what? $98? I spend more than that on... Okay, go on.
Yeah, if the market crashes the year we retire, we'll literally be, selling our beach house brick by brick just to buy eggs.
Okay, I need a second. You're saying that the richer plan actually makes us broke in daily life?
Exactly. Same $10,000 investment, same 3 funds, but 2 completely different destinies. Today, we're showing you why total wealth is a trap and how to build a portfolio that actually pays you to live.
I'm Lynn.
And I'm Frank. Welcome to Talk and Wonder. We create easy-to-understand whiteboard animations covering family finance, investing, and, well, making sure we don't end up house rich and cash poor.
Exactly. Our goal is to break down complex financial topics, help you avoid traps, and build wealth together. But quick reality check before we jump in. We are not your financial advisors.
Right. Please do your own homework before investing. We're just sharing the math on what happens when you take 10 grand and put it across the 3 best Fidelity Index Funds.
Okay, so 10 grand, 3 funds. How does a normal family even build this without messing it up?
Well, every portfolio needs 3 jobs handled. You need income, you need growth, and you need the rest of the world. The first fund handles the income. It's FDVV, the Fidelity High Dividend ETF.
Dividends? Frank, honestly, when I hear dividend funds, I just picture, I don't know, my grandma's boring utility stocks, like the local water company.
See, that's exactly what I thought too. But if you actually look under the hood of FDVV, you'll see the top holdings are names like NVIDIA, Apple, Microsoft, Broadcom.
Wait, what? NVIDIA? Like the AI chip company? Since when are they a dividend stock?
Right? That's a super fair reaction. Most people still think of dividends as, well, exactly what you said, sleepy companies. But the thing is, these tech giants got so massive that even a tiny percentage of their profits equals a huge payout. I mean, Apple alone,
Don't tell me.
Apple paid out over $15 billion in dividends last year.
15 billion with a B? Okay, Grandma's water company is officially canceled.
Exactly. So FDVV isn't chasing yield from dying companies. It's holding the biggest, most profitable businesses in the world. And right now, those businesses are starting to pay real income back to us.
Okay, but let's bring this back to our kitchen table for a second. For someone who might be totally new to this, a dividend is basically just what, a quarterly thank you check for holding their stock?
That is actually the perfect way to put it, yeah. It's a piece of the company's profit, usually paid out every 3 months. And the math is simple. The more shares you own,
The bigger the check.
you got it. That's the whole game. Now, FDVV currently runs at let me make sure I have this right. Yeah, a 2.8% dividend yield.
Okay, Frank, I love you, but 2.8%? Our high-yield savings account is paying like, what, 4 or 5% right now? Why would we take the market risk for less yield?
Okay, that is the exact trap so many people fall into. Savings account rates, they can drop overnight if the Fed cuts rates. But FDVV has a 5-year dividend growth rate of 10.85%.
Oh, so the actual paycheck they send you gets bigger over time.
Exactly. It's like getting a nearly 11% raise on your passive income without doing any extra work. And on top of that, the actual share price goes up too. Historically, it appreciates about 9.16% a year.
Okay, so it's not just a flat payment. It's an income stream that actually keeps up with inflation and our kids' ridiculous grocery bills.
Don't even get me started on the grocery bills. But yeah, that combination of yield and growth is what makes FDVV the income engine of the portfolio. So, job number 1 is handled. We have our income covered.
Right, but income alone doesn't get us to that crazy 700K number you teased earlier. We need something more aggressive?
We do. We need growth, like as fast as possible, which brings us to fund number 2, FNCMX, the Fidelity Nasdaq Composite Index Fund.
Sounds like a radio station.
Right? But this is the one built to grow the account as fast as humanly possible.
Okay, I like the sound of that.
Right? So FNCMX tracks the entire NASDAQ composite. That's around 3,000 companies. Now, quick context here, because this trips a lot of people up. The NASDAQ isn't a fund or a specific tech company. It's a stock exchange.
But it's basically all tech, isn't it?
Well, yeah, most of the big tech companies in the world happen to list their stock on it, which is why this fund is heavily weighted toward innovation. The top holdings are Apple, Microsoft, Nvidia, Amazon.
Wait, hold on a second. Didn't you just say Apple and Nvidia were in the first fund, the dividend one? Are we just buying the exact same things twice?
Ah, see? I knew you'd catch that. Yes, they're the same names in some cases, but at very different weights and for completely different reasons. FDVV picks them because they're paying out cash. FNCMX picks them because they're taking over the world. It's pure offense.
Okay, so show me the numbers. How offensive are we talking?
The numbers tell the whole story. FNCMX runs at a tiny 0.48% dividend yield, barely anything. But, and this is a massive but, it has a 17.45% annual share price appreciation.
Wait, 17%? Every year? Okay, wow, so this is the engine that gets us to the beach house.
Exactly. That 17.45% is the highest of any of the 3 funds we're talking about today. So, now we have our income covered, we have our American growth covered, but everything in the portfolio so far is American.
And, I mean, American tech is kind of running the planet right now. Do we really need to look anywhere else?
We do. A bulletproof portfolio needs global diversification, which is why the third fund is FTIHX, the Fidelity Total International Index Fund. It tracks over 5,000 stocks across, developed markets like Japan and the UK, and emerging markets like India and China. Basically, the entire world that isn't America.
Okay, but Frank, let's be real for a second. International stocks they've kind of sucked for the last decade, right? They've completely underperformed the U.S. Why would we put our hard-earned money into a fund that's losing the comparison?
I almost skipped this one for that exact reason. But here is the thing. Every family portfolio needs something that doesn't depend on America. If the U.S. has a bad decade, and it has happened before, this fund is the floor that keeps our family from falling through.
So it's basically insurance. You hate paying for it when you don't need it, but
it saves your life when you do, exactly. And there is something else about FTIHX that nobody talks about.
What?
So, it has a decent 2.54% dividend yield, but its 5-year dividend growth rate?
Yeah?
16.98%.
Frank, stop. 16.98%?
Yep. That is higher than either of the other 2 funds. The boring international fund that everyone ignores, it actually has the fastest growing dividend engine of all 3.
Okay, my mind is a little blown right now. So we have our 3 players, the Dividend Cow, the Nasdaq Growth Rocket, and the International Dark Horse.
Right. But here's the part that 99% of people completely miss. Picking the funds isn't actually the entire decision. It's not even the most important part.
Then what is?
It's the recipe. It's how much weight you give each fund. Because those exact same 3 funds can build 2 completely different destinies.
Okay, I'm listening. Show me the recipe.
All right, let's start with the version everyone thinks they want, the growth-tilted portfolio, the one designed to get the account balance as big as possible. To do that, we flip the weights almost entirely to offense. 70% goes straight into FNCMX, the Nasdaq fund.
Whistle, 70%. Okay, so we are just strapping ourselves to the tech rocket. That feels a little terrifying, actually.
It is aggressive. But remember, its annual appreciation is over 17%. If you want a massive account, you have to ride that growth hard.
Fair enough. What about the other 2?
FDVV, the dividend fund, drops down to 20%.
Wait, only 20? But you just spent all that time hyping up how great their dividend growth is.
I know, but in a growth portfolio, dividends just aren't the priority. We keep 20% just to keep some cash flowing without, dragging the overall speed down. And then FTIHX, the international fund, drops to 10%.
Ah, so international becomes basically, what, a token hedge, just in case?
Exactly, a safety net, but not the core engine. Now, when you blend those weights together, the yield drops to a tiny 1.15%, but the annual appreciation, it jumps up to 14.67%.
Okay, so we're essentially trading current cash for future zeros in the bank account.
You nailed it. And those zeros pile up fast. Let's look at the projections. After 10 years, the original 10 grand turns into about $42,000. After 20 years, it's sitting at roughly $173,000.
Not bad for a 10 grand investment.
Right? But year 30 is the headline. The portfolio is projected to hit $699,555.
Yes, stop the clock. We did it. That's the beach house right there. 700 grand, Frank.
Look, yes, on paper you have 700 grand, but here is the massive red flag. Of that almost $700,000, roughly $675,000 of it came purely from capital appreciation, meaning the share prices just went up.
And isn't that the whole point of investing? Buying low and watching it go up?
It is until you actually want to spend it. See, because this portfolio pays almost nothing in dividends, there was barely any dividend reinvestment. The whole engine is just share price. It's money on paper, not money in your pocket.
Okay, I feel like you're setting me up for a really depressing number. How much money actually goes into my pocket?
By year 30, this massive $700,000 portfolio is projected to pay you $98 a month.
Frank, stop. Wait, are you serious right now? $98?
$98.
I literally spend more than that on my coffee runs. How does a $700,000 account not even cover a nice dinner out?
Because that's the trade-off. You built a machine designed to hoard wealth, not distribute it. If you want cash from this portfolio to pay your electric bill, you have to sell off your shares.
Oh, so I'm not living off the interest, I'm slowly butchering the golden goose.
Exactly. And if you have to butcher the goose during a year when the stock market is crashing, you're essentially selling your shares at a massive loss just to survive. It's what financial nerds call sequence of returns risk.
Sequence of returns risk. Okay, sounds like a really boring horror movie.
Oh, it is a horror movie for retirees. Imagine retiring the year the market drops like 30%. You still need, say, $3 grand a month to live, right?
Right, the grocery store doesn't care if the S&P 500 is down.
Exactly. So to get that $3 grand, you have to sell way more shares than you normally would because the price is down. You drain the account faster and it never recovers.
Okay, but wait, Frank, let me play devil's advocate for a second. Everyone always talks about the 4% rule, right?
Sure, the standard retirement rule of thumb.
Yeah, so 4% of a $700,000 portfolio is about 28 grand a year, which is roughly $2,300 a month. So doesn't the growth portfolio still give us more money anyway?
Okay, look at you doing the math. I love that. And you're right, on paper, the math works. But here is what changes in practice. With that 4% rule, you're still doing what?
Selling shares, shrinking the pie.
Shrinking the pie, exactly. But there is another way, the version that pays you the $2,048 a month.
Okay, lay it on me. How do we build the golden goose that we don't have to butcher?
We flip the weights again. This is the dividend-tilted portfolio. And the biggest slice, 50%, goes to FTIHX, the international fund.
Wait, 50%? Half our money in the international fund? The one we literally just called a backup plan?
Yes, because remember its secret weapon?
The 16.98% dividend growth rate.
Boom! Over 30 years, that is the engine that compounds your income the absolute fastest. Then 30% goes to FDVV, the tech giants, for the immediate cash hitting the account today, and only 20% goes to the Nasdaq Growth Fund.
Just to keep the account from completely stalling out.
Right, and if you notice, even with 50% international, the other two American funds still equal 50%, so it's perfectly balanced.
Okay, so let's fast forward 30 years. What does this one look like?
The total account grows to $416,613.
Okay, so significantly smaller than the $700K. I expected that.
But here's the magic trick. Of that growth, over $151,000 came purely from dividend reinvestment, meaning the dividends bought more shares.
Which paid more dividends, which bought more shares, the snowball.
The snowball gets enormous, and the final result? By year 30, this portfolio is projected to pay you $2,048 every single month.
Without selling a single share.
Exactly. The account stays whole. The shares stay invested. The dividends just keep hitting your checking account, whether the market is up, down, or completely sideways.
Wow, okay, so one portfolio gives you a giant number to brag about at parties, but you're terrified to touch it, and the other gives you actual freedom, like a lifelong rent subsidy for our family.
Beautifully said. Neither portfolio is technically wrong. They're just two completely different bets on what you want your money to do for you. But 30 years is a long time.
Yeah, I was just thinking that. What if someone doesn't have 30 years? Like, what if you only have 20, or, God forbid, 10 years until you desperately need to retire?
Well, that is a completely different beast entirely. I actually ran the numbers on what it takes to hit $1 million on Fidelity Index Funds across all three timelines. And let me tell you, the 10-year strategy, the math on that one basically forces you to.